Is AI eating the economy? I know, that sounds a little bit clickbaity, and honestly, that's what I thought too. But over the last few weeks, I've kept seeing the same headlines over and over again. Microsoft is spending more, Meta is spending more, Amazon is spending more, Alphabet is spending more. Every week, another mega tech company announces another massive investment in artificial intelligence. At some point, I stopped asking, how much are they spending? And instead, I started asking a different question. Where's all this money actually going? Is AI really creating new economic growth, or is it simply replacing growth that would have happened somewhere else? Because if it's the second, that's a much bigger story than most people realize. It doesn't just affect NVIDIA, it affects your retirement account. It affects interest rates. It affects the economy you work in. And maybe it even affects the prices you pay every day. Now, I actually think AI is going to end up being one of the most important technologies of our lifetime. But I think there's a much more interesting question hiding underneath all the data. Is AI simply making the economy stronger? Or are we becoming too dependent on it? Maybe even dangerously dependent. And maybe the biggest question of all, what does any of this mean for your lunch money? Anyways, welcome back everyone to the Lunch Money Investing channel. If you're new here, every week I take a surprising thing happening in the economy. I dig into the data and then I talk about what it actually means for everyday investors like you and me, so we can protect our lunch money. So let's start with what happened this week. On the surface, the economy actually looks pretty healthy. The final estimate for first quarter GDP came in at 2.1%, revised higher from a previous estimate of 1.6%, as exports were revised lower. Inflation data was mostly in line with expectations. Headline PCE came in at 4.1%, while core inflation is still sticky at 3.4%. And because there weren't any major surprises, the market barely reacted to this news. Investors overall are still pricing in roughly 60% chance of another rate hike later this year. So, if you just looked at the headlines, you'd probably think, okay, nothing too crazy. But the GDP data tells us something much more interesting than whether the economy grew. It tells us what actually caused the economy to grow. And that's where this week's report gets really interesting. Because according to multiple economic estimates, AI-related investment contributed somewhere between 1.3 and 1.5 percentage points of the 2.1 GDP growth we saw in the first quarter. Think about that for a second. If the economy grew 2.1% and AI contributed somewhere around 1.4 percentage points, that means AI may have been responsible for roughly 2/3 of all economic growth during the quarter. That's an incredible statistics on its own. But here's why I got confused. Consumer spending still makes up roughly 68% of the US economy. That's normal. In a healthy economy, consumers are usually the main economic driver. We buy groceries, we go out to eat, we book vacations, we buy cars. Businesses hire workers, workers earn paychecks, and the cycle continues. That's basically how the US economy has worked for decades. So here's what didn't make sense to me. If consumers still make up almost 70% of the economy, how can AI suddenly be responsible for 2/3 of that growth? Those two things seem like they completely contradict each other. The answer comes down to one really important distinction. There's a difference between what the economy is made of and what actually caused it to grow this quarter. Those two aren't the same thing. Imagine you own a company. Your customers come, they spend the same amount of money this year as they did last year. Nothing really changes there. But then you decide to spend hundreds of millions of dollars building AI data centers. Suddenly, you're buying servers, computer equipment, networking hardware, software, and all kinds of expensive infrastructure. GDP counts all of that as new economic activity. Now imagine Microsoft does it, Amazon does it, Meta does it, Alphabet does it, all at the same time. Now that statistic starts making a lot more sense and the data backs it up. Business investment grew at a really healthy pace this quarter. But when you dig into where that investment actually went, you find something fascinating, even interesting. Information processing equipment, basically the hardware behind AI, surged nearly 16%. Software and intellectual property investment jumped almost 14%. Those weren't small increases, these were huge. and together they helped offset weakness showing up in other parts of the economy. And this naturally raises the next question. If AI is doing all the heavy lifting, what parts of the economy aren't? And that's where this story takes another turn. So far, we've learned two things. First, the economy actually had a pretty solid quarter. GDP grew at an annualized rate of 2.1%. Second, AI investment may have been responsible for roughly 2/3 of that growth. Now, here's the obvious question. What happens if you take AI out of the picture? Because that's exactly what economists and investors started asking after the report came out. And honestly, I think the answer is the most interesting part of this entire story. According to Pantheon Macroeconomics, overall business investment grew during the first quarter. Sounds great, right? Businesses investing more money usually means they are optimistic about the future. But here's the catch. If you remove the massive increase in software spending and the huge jump in computer equipment, basically all the AI related investment, business investment actually turned negative. So what does that actually mean? Without AI, corporate America wasn't really accelerating, it was slowing down. Now, that doesn't automatically mean the economy is in trouble, but it does suggest something important. Right now, AI isn't just another fast-growing sector of our economy. It's becoming the thing that's masking weakness in other parts of the economy. And once I realized that, I wanted to know exactly where that weakness was coming from. The first place I looked was housing, because historically, housing has been one of the biggest drivers of economic growth. Think about everything that happens when someone buys a house. They hire movers, they buy furniture, they renovate the kitchen, they buy appliances, they landscape the backyard, the front yard, and the sides. One home purchase creates spending across dozens of different industries. That's why housing has always been such an important part of the US economy. But that's not what we're seeing today. Instead, residential investment fell almost 8% during the first quarter. Even more surprising, this was the fifth straight quarter of declining housing investment. And compared to where we were back in early 2021, housing investment is now down roughly 18%. Higher mortgage rates are still weighing on the housing market. So one of the economy's traditional growth engines really isn't contributing much right now. It's actually being a drag. Okay, so housing is weak, but consumers are still spending, right? Yes, but there's another layer to that story. Consumer spending was up roughly 2.7% compared to a year ago. That's a healthy figure. People are still traveling, they're still eating out, they're still shopping. The American consumer hasn't disappeared yet. But economists have started noticing something. Consumers are increasingly keeping that spending going by drawing down their savings, using more credit card debt, and benefiting from higher asset prices. In other words, people are still spending, but they're having to work a little harder to keep that spending going. Again, I'm not saying there's an immediate problem today. The consumer has been much more resilient than almost anyone has expected over the past couple of years. But it does mean the economy isn't being carried by consumers in quite the same way it has been historically. Instead, it's increasingly being carried by corporate investment, and more specifically, AI investment. So naturally, the next question becomes, who's actually spending all this money? The answer won't surprise you. The usual suspects: Microsoft, Amazon, Meta, Alphabet, Oracle, and so on. Pretty much every major technology company is locked in what has become an arms race. Nobody wants to be the company that underinvests if AI turns out to be as transformative as many people believe. So they're building, and they're building fast. Data centers, AI chips, networking equipment, power infrastructure, cooling systems, software. Pretty much anything required to support artificial intelligence. Altogether, these companies are expected to spend more than $800 billion this year on AI infrastructure. $800 billion. Just pause and think about that for a second. Think about how much money that actually is. That's larger than the annual economic output of many countries. And some estimates suggest that the number could climb above $1.1 trillion next year. That's a massive amount of capital flowing into one area of the economy. Now here's the next question that keeps coming back while researching this video. If companies are spending nearly $1 trillion, where does that money actually come from? It has to come from somewhere, right? Businesses don't have unlimited budgets. Every dollar spent building AI infrastructure is a dollar that can't be spent somewhere else. Or it's a dollar that eventually has to be earned back. And that's where this story becomes a lot more personal for me and for you. Because AI isn't just changing the economy, it's starting to show up in everyday life. Take Apple. As the company adds more advanced chips and AI capabilities into future devices, those costs become part of the overall cost structure of the product. Or look at Microsoft. The company recently increased prices on Xbox consoles and its accessories. Now, to be fair, there's never just one reason companies raise prices, right? Inflation, tariffs, labors, supply chains, they all play a role. But increasingly, high performance chips and AI related hardware are becoming part of the equation. The point isn't that AI is the only reason prices are rising. The point is that someone ultimately pays for these massive investments. Companies can absorb some of the cost, but only so much. Shareholders can absorb some of that cost as well. And eventually, consumers often absorb part of it too. So let's stop for a second and put everything together. Housing is weak. Consumer spending is still growing, but showing some signs of strain. Traditional business investment looks much less impressive once AI is removed from the picture. Meanwhile, the biggest technology companies in the world are spending close to $1 trillion building AI infrastructure. At this point, you could make a pretty compelling argument that AI has become the primary engine of economic growth. But we're still missing one really important piece of the puzzle. Because AI isn't just becoming more important to the economy, it's becoming more important to your investment portfolio too. And once I looked at those numbers, that's when this entire story really clicked for me. Because the question isn't just whether the economy depends on AI, it's whether your portfolio does too. So far, we've talked about the economy. Now let's talk about your portfolio, because this is where the story really hits home for me. Whether you realize it or not, most investors today have a lot riding on artificial intelligence. If you own an S&P 500 index fund, a 401k, or pretty much any broad US stock fund, you're probably much more exposed to AI than you think. Today, AI-related companies make up roughly 45% of the S&P 500's total market capitalization. Just think about that for a second. Nearly half of America's largest stock index is tied to companies that are either building AI, selling AI infrastructure, or supplying the chips, software, and equipment that makes it all possible. Now, before anyone misunderstands what I'm saying, this is not necessarily a bad thing. History is full of periods where one technology transformed the entire economy. Railroads, electricity, the internet, smartphones. The companies leading those revolutions created enormous amounts of wealth for investors. AI could absolutely become the next chapter in that story. But it also changes where the risk lives. Because when one theme becomes this dominant, the market becomes increasingly dependent on that theme to continue to deliver. And that's why I don't think this is necessarily about AI. Instead, I think it's a story about concentration, which actually brings me to my own portfolio. One of the reasons I started this channel is because I wanted to publicly document my journey of investing small amounts of money every single week. The idea is simple. You don't need to be rich to start investing. You just need to be consistent. This week, my M1 Finance portfolio finished at $2,538, down 2.6% for the week, while the S&P was down 2.4%. So I performed pretty much in line with the broader market. Looking at the individual pieces, my leveraged equity components were the weakest performers, down about 4.6%. Crypto was also under pressure, falling around 5.5%. But here's what I found interesting. My bond allocation actually gained around 1.3% for the week. My custom REIT portfolio was up roughly 3.7%. Gold held up relatively well. And despite the market pulling back, I invested another $185. That's something I want to continue doing every single week. Not because I know where the market is going tomorrow. I don't know. No one knows. And whoever says they know is lying to you. But because I believe volatility is something to take advantage of, not something to fear. Now I want to spend a minute explaining why this portfolio looks the way it does. because I think it ties directly into everything we've talked about so far today. When most people hear long-term investing, the advice is usually pretty simple. Buy an index fund. Keep buying, don't overthink it. And honestly, that's fantastic advice for a lot of people, for most people. But I've always wanted to build something a little bit different. Not because I think I'm smarter than the market, but because I like the idea of having multiple return streams working for me. Stocks, bonds, real estate, gold, crypto. These assets don't all move for the same underlying economic reasons. Sometimes they all go up or down together. We've definitely seen that before. But over long periods of time, they tend to respond to different economic environments differently. When stocks struggle, maybe bonds provide some stability. When inflation picks up, maybe gold helps offset part of that. When real estate recovers, REITs might outperform. The goal isn't to eliminate volatility. That's impossible. The goal is to avoid having every dollar of your portfolio depend on the exact same thing. And after researching this week's topic, that idea feels more important than ever. Because whether we're talking about my portfolio or the US economy, the same question keeps coming up. How much concentration is too much? Now, I also want to present the other side of this argument. Because after watching this video, it might sound like I'm skeptical about AI. I'm really not. I love AI. I think it's fantastic. In fact, I think there's a very good chance we're still in the early innings of one of the biggest technological revolutions in human history. Every major breakthrough has required enormous investment before society saw the benefits. Think about the railroads, the internet, electricity, even the interstate highway system. All of those required massive amounts of capital before businesses figured out how to fully take advantage of them. AI could be following that exact same path. Today's spending could become tomorrow's productivity boom. Doctors diagnosing diseases faster, engineers designing products more efficiently, small businesses automating repetitive tasks, students learning in completely new ways. If that happens, hundreds of billions of dollars being invested today could end up looking like an incredible bargain tomorrow. And that's why I don't think the question is AI good or bad? I think that's the wrong question. The better question is, will all of this investment eventually create enough value to justify it? The truth is, none of us know yet. It's too early. And that's okay. As investors, we don't need to know exactly how this story is going to end. We just need to understand the risks we're taking on when we invest. Which brings me back to the question we started with. Is AI eating the economy? After spending this week digging through the data, I actually don't think that's the right way to think about it. I don't think AI is eating the economy. Instead, I think the economy is increasingly feeding AI. AI-related investment accounted for roughly 2/3 of GDP growth this quarter. Without AI, business investment would have looked dramatically weaker. The biggest technology companies in the world are spending close to $1 trillion building the infrastructure behind it. AI-related companies now represent nearly half of the S&P 500. Those aren't opinions. They are simply the direction the data is pointing to. Now, does that mean we're headed for another tech bubble? Not necessarily. This could turn out to be one of the greatest investment opportunities of our generation. Or it could simply be another reminder that every major technological revolution comes with some growing pains. Either way, I think there's one sentence I'll be thinking about long after this week's data is forgotten. The biggest risk isn't AI. Instead, it's what happens when everything depends on AI. And whether that's brilliant or dangerous is one of the biggest investment questions of this decade. And that's what I want to leave you with today. Do you think artificial intelligence is laying the foundation for decades of economic growth? Or do you think we're becoming too dependent on one trend? I'd genuinely love to hear what you think. So let me know down in the comments. If you enjoyed this video and like taking a deeper look at what's really driving the markets, consider subscribing and like the video. Every week, I'll break down one surprising story from the economy, explain why it matters to you and your lunch money, and show you how I'm investing my own lunch money along the way. Thanks for watching today's video. I'll see you in next week's episode. And as always, protect that lunch money.